Good afternoon, everyone. I'm Johannes Urpelainen. I am a professor at the Johns Hopkins School of Advanced International Studies and the founding director of the Initiative for Sustainable Energy Policy, or ISEP, which is hosting today's webinar together with the Energy Resources and Environment Program at SAIS. What we are going to do today is we are going to first hear from our distinguished speaker, Professor Paasha Mahdavi from University of California, Santa Barbara, who's going to tell us about oil nationalization and the energy transition, a very, very timely topic in these times of turmoil in the world and in the energy market. Then after that, we are going to open it for a Q&A, which I will moderate. So you can use the Q&A box in Zoom to ask any questions, and I will then communicate those to Paasha, and we will have a discussion around them. So thank you for joining us today. Please do check out the ISEP website, which is sais-isep.org. I'm going to put it in the chat window. You can find all about our research, events, and updates on the website. And with that, I would like to welcome Professor Mahdavi. Please tell us about this issue of oil nationalizations and energy transition. Paasha, could you? Okay, perfect. You're on mute.
Yes, there we go. Excellent. Well, thank you very much, Johannes. Thank you to the SAIS team for putting this together. Let me go ahead and share my slides with you all. Just want to make sure you can see that. A thumbs up, Johannes, if that works.
Absolutely.
Perfect. Well, excellent. So as Johannes mentioned, I'll be talking about the politics of oil nationalizations and its implications for the energy transition. I have two objectives really for this talk. The first one is to discuss the deep political roots of oil nationalizations and draw a lot of the research from my book, which was just published in April, called Power Grab: Political Survival Through Extractive Resource Nationalization. It's available from Cambridge University Press, which goes into the political decision-making of oil nationalizations, and in particular, this idea of nationalizations as a gamble, the high-risk, high-reward nature of nationalization, but one that's motivated by the insecurity of political leaders, something we haven't really thought about up until this point. But then I'll discuss why leaders would want to do this in the first place, and something we have great research on about nationalization and national oil companies in particular as a tool for political survival. It's something that Johannes and some of his team have looked into as well. And I do want to address some issues with oil nationalization, not just being something of the past, but also something that's going on now, as well as how it impacts kind of non-oil resources. But then I want to turn to looking at nationalization in the context of the clean energy transition and the implications of nationalizing assets and operations, and whether or not this will be a help or a hindrance to the transition to clean energy. On the one hand, I'll talk about nationalization of extractive resources that are critical for clean energy. But on the other hand, I'll talk about, go back to talking about oil and thinking about national oil companies and their role in decarbonization. They of course are still crucial stakeholders, even though they may or may not, and this is the open question, have a role to play, and I'll be talking about that. Excellent. All right. So I want to first start by asking the question, which is why should we even care about nationalization, in particular national oil companies? Just this one sector. Well, a few reasons come to mind, and the first is just the sheer size. National oil companies worldwide own about $3 trillion in oil and gas assets. Right? Compare that to the top 10 international oil companies like Exxon and Shell, which own about $1.9 trillion in assets. Again, this is as of 2017. And national oil companies pull in $2 trillion in revenues. Right? That's quite large. From a political standpoint, and in terms of the economy of several countries, in these states, national oil companies and broadly extractive resource state-owned enterprises, or SOEs, are the economy, right? For national oil companies, for example, some great research by folks at the National Natural Resources Governance Institute, NRGI, have found that 18 national oil companies collect somewhere between 20 and 90% of overall government revenue. I mean, that is remarkable. They really are the economy in some of these states. And of course, they still control the majority of global oil production and the vast majority of global reserves. Now, politically, if you think about national oil companies, these are events that are ubiquitous. In effect, nationalization is the norm in the oil industry, with the exception of the US. Right? Every major oil producer is nationalized at some point in time. 27 of the top 30 producers now have national oil companies. The three that don't are the US, UK, and Canada. The latter two, UK and Canada used to have national oil companies, but they don't anymore. They privatized in the 80s and 90s. But you can see it follows a rich history over time. You go back to Lázaro Cárdenas in 1938, Mexico, Mohammad Mossadegh in Iran in 1951, of course, Muammar Gaddafi in 1973 in Libya, and 73, as I'll show you in just a moment, big period of nationalization. But it isn't just something of the 30s through 70s. 8 years ago, Christina Kirchner in Argentina nationalized YPF, Repsol YPF in the Spanish oil company. So if we think about it cumulatively over time, what I've done is put together a database of operational nationalizations. And here is what I get into more in the book, looking specifically at nationalizations in which the state has a majority ownership of production and control over oil and gas operations. So they are de facto operating these assets rather than something that exists de jure or simply in the law as being under the control or aegis of the state. So looking at operational nationalizations over time, you can see the cumulative growth of national control really ticking up after the mid 60s and in the 70s. You see this big wave of nationalization, and you still see some dips and increases. Of course, deregulation in the 80s and in the 90s, the post-Soviet era. But you still see increases in nationalization, especially in some of those contexts after the fall of the Soviet Union. And I've juxtaposed this with the real oil price in red here to show that by and large, you do see a pattern that nationalizations coincide with increased commodity prices, something to remember when we think about other commodities at risk to nationalization. But that doesn't tell the whole story. This isn't just about capturing windfalls when times are good. Of course, some of the most prominent nationalizations in the oil industry happened well before the oil price shock and in a period when oil prices were relatively low. Mexico, Iran, and Venezuela, Kuwait as well. So it's not just a story about prices, but it is prices do certainly help explain a lot of the story. Now, what's interesting is that you have this ubiquity of nationalization, but there are so many risks of nationalization, and this is kind of the highlighting one element of the gamble. Why is this such a high risk? Well, operationally, what a lot of research has found, kind of work that's been done by economists in particular, shows that national oil companies are more inefficient, operationally speaking. Some great work by Christian Wolff back in 2009 found that NOCs produce up to 50% less than non-national oil companies, that is, compared to multinational oil firms. And more recent research last year, Christina Brinschweiler and co-authors looked at in exploration, NOCs are far less successful in discoveries, especially when they go alone. So there is an operational cost when it comes to how much oil you're pumping from the ground and how much oil you're discovering. There's also issues of corruption, and this is something that is synonymous with national oil companies kind of around the world. There are a lot of highlight cases that you see in the papers graphed by national oil company officials, say Nigeria's missing billions, the Luanda leaks, $2 billion captured by Isabella dos Santos in Angola through Sonangol, the car wash scandal in Brazil. And I found in my own work that national oil company officials are more likely to solicit bribes from multinational corporations when they are in charge of regulation. So there are costs on this side as well. There's also an international investment cost. That nationalization has been linked to lower foreign direct investment in both the oil sector and in other sectors in the broader economy, right? You become less trustworthy as a haven for investment as you start expropriating. But there's actually some interesting debates around that. Now, there's some more serious costs and risks, really, when it comes to international retaliation. One of the more minor ones, if you can call it that, are sanctions and penalties. In the case of Argentina, for example, they were slapped with a $5 billion penalty when the case went to arbitration. So no small cost, and in fact, almost outweighed any of the benefits that came from nationalization. There are also, if you look farther in the past, instances of embargoes. The Mexican nationalization was met by an oil boycott from the US. The Iranian nationalization famously responded to by the international market with an oil embargo in 1951. And then even perhaps the most serious risk is the threat of violence. The Iranian case is kind of a symbol emblematic of this in 1953, the coup, the ousting of the democratically elected leader Mohammad Mossadegh and the replacement of the Shah, Mohammad Reza Pahlavi. So that threat looms large in many leaders' minds, because you certainly don't want to be, take on a decision that's going to see you ousted out of office. Well, so then you might be thinking, well, this is ubiquitous, but we have all these costs. So then why is it ubiquitous? Why is everybody nationalizing? Why take on this risk? Why do we see so many nationalizations? And as with so many other stories, the answer is follow the money. This is about revenues. This is about money that leaders can use to stay in power. And it connects with some work in political science, Margaret Levy's classic work in 1989, Rule and Revenue. And in this case, it's revenue that leaders can use to shore up political support. And it's money that would otherwise be flowing outside the country. This is a particularly big problem in the oil industry because lots of these operations had been handled prior to nationalization by foreign oil companies, not necessarily domestic ones. So it's money that's leaving the country. This is an opportunity to capture that and use it to stay in power. And so many of the risks that I talked about before are downweighted for leaders who feel that they may just not have any more days in office. They may feel that though they have no other choice but to take on a really big risk. Otherwise, they're going to see themselves ousted for other reasons. I'll talk about that in a few slides. Now, it's not to say this is the only route to go. I've talked about operational nationalizations. There are softer versions of this that many others have pursued that are more risk averse, leaders that are more risk averse. Less direct and aggressive forms, less aggressive forms of nationalization. So things where foreign firms basically continue to operate the majority of production and operations, but you still maintain sovereignty over those resources. So there are non-operational nationalizations, but they don't come with the same high reward. So let me talk about the money side for just a bit. I don't want to go too deep into the book's empirical work, partly for time, but partly also if you're interested, please do go out and buy the book. The first is looking at this question of, is it really the case that nationalization increases money? If this is about money, do we actually see leaders collecting more money? It's a question that's plagued a lot of prior work because it's been hard to identify causally. It's also been really difficult to pinpoint the actual amounts of money that are going to governments themselves, not the total pie of oil revenues, but how much is actually being collected by the Treasury. This is notoriously hard to do because countries keep a lot of this information secret. So does it actually increase revenues? Well, I put this to the test, and I thought carefully about trying to isolate the causal effect. And in addition, try to measure the exact amount of money that's being collected. And I looked at the case of Iran, their nationalization, or really renationalization in 1973, before the oil price shock. And to do this, I went to the archives to analyze monthly oil receipts and compared them to projected receipts from companies who were ultimately ended up being nationalized. We didn't think they were going to be nationalized. That's mostly British Petroleum, BP, and the consortium. So what did I find, in the analysis? Well, indeed, there is a causal effect of nationalization. And in particular, nationalization in Iran, in this case, ended up resulting in $164 million more per month than would otherwise have been the case. and that's across the 17 months after nationalization, for which this, the window that we can examine here, that's almost $3 billion more money than they would have otherwise had they not nationalized. And this revenue was essential at the time. It allowed the Shah of Iran to vastly expand social services, co-opt elites. There was a follow-up on an earlier set of reforms called the White Revolution. This was the 10th anniversary of that in 73, 74, 75, to allow the Shah to stay in power. But of course, it was short-lived, and I go into more of this in the book. This didn't last for a number of reasons, famously because the Shah didn't actually control the sale of oil. He nationalized it, produced it through the National Oil Company, but the British and the Americans still held control of oil trading in the market. So there was a reversal of nationalization in 1976. But we can still see in this era that there was a dramatic increase in revenues when the Shah needed the money. Now the big question, and kind of broadening the scope out to the big question of survival, what does this mean? If my argument is true that, in fact, leaders are doing this to survive in power, by and large, do we see them surviving more often than not, had they not nationalized? Well, indeed, so here I zoom out and look at every country, 175 countries, at least countries above a million people, over 110 years worth of data, and indeed found that nationalizers were more successful in staying in power than non-nationalizers. Indeed, if you didn't nationalize, you were up to 3 times more likely to be ousted as a leader from power than those who did nationalize. And again, in one of the book's chapters, I complement the statistical work here with a number of case studies talking about Baathism in Iraq and how this allowed Baathism to survive in an era where there were coups every year after the fall of the Iraqi monarchy. The same story in Libya. The House of Saud is an interesting case because Saudi Arabia opted not to nationalize early and then did. And then I talk a bit about Putin's Russia and Vladimir Putin's decision to nationalize after the fall, of course, lots of private operations and to consolidate oil operations in the hands of the state, and how this benefited Putin's regime. So I want to very briefly talk about, before moving on to the implications of nationalization for clean energy, talk a little bit about the sparks for nationalization, why it happens when it does, and in particular, what are the signs to look for in industries that haven't nationalized, right? Not like oil, but other industries. And the first are what I call the preconditions, which are, you must have the technical capacity to nationalize. There are lots of examples in the past of failed nationalizations, when countries simply lacked the homegrown skill to manage operations and also be able to manage future investment and exploration. This is, the Shah kind of classifies as this a little bit in terms of the inability to control oil sales, but this speaks also, more generally to geological technical capacity. The second is the spread of information, and this is key. This is a bit more of a complex story, but it's one about how much host governments know about the revenues that are coming in and the terms that they have with producing firms compared to their neighbors, compared to their competitors, compared to other countries. And once that information spreads, nationalization becomes more likely, because you start to see the need for narrowing these big gaps that might exist between firms and host countries. And the third is what I've gone through a little bit so far about the issue of short time horizons, to put kind of a term on that. The idea here being that when leaders feel pressure, they feel perceived threats to rule, and other fiscal pressures, if they just believe they have low odds of survival, this becomes a more appealing risk to take, because it does have this high reward, and of course you have less to lose if you don't think you're going to be around for much longer. The Shah certainly felt this way. This was a big story of Gaddafi. It's what I opened the book with. When you're faced with that kind of existential threat, you're more likely to take these kinds of gambles. All right, so let me turn now to talk about move away from history, move away from the work of the book as well, and think about the last section of the book, as well as some of my other work. What implications does this have for the future? What implications does this have for the transition to clean energy? Well, first we want to think about other resources and other extractive resources that are still going to be part of the value chain and the supply chain. And many of those that are indeed at risk of expropriation. So, you know, there are, in particular, some resources that are not only geographically concentrated, but are concentrated in places that I've, you know, identified in my argument as being more high risk for nationalization. So, you know, you think about tantalum, which is concentrated in Rwanda. Cobalt, of course, is a story, you know, it's been in the news here and there, which is, you know, very concentrated in the Congo. Niobium in Brazil. You know, manganese a little less concentrated, but in Gabon. But there's also manganese in South Africa. And indeed, this has been a critical issue. With tight supply chains and in particular growing demand, so much so that over the summer, you know, the U.S. Assistant Secretary of State for Energy Resources, Francis Fanon, had warned that the largest reserves of metals and minerals for renewable technologies, including cobalt, but also lithium and nickel for batteries and others, are found in weak states with poor governance records. And congressional Republicans had sought to address this problem over the summer, introducing legislation to encourage U.S. production of critical minerals. In particular, part of this is to lessen reliance on China. China controls a lot of critical resources, some of which are already under state control, of course. And part of it is to increase, you know, homegrown production of this. We're seeing this in California here, lots of lithium reserves that exist out in the desert, in the Mojave and near Joshua Tree as well. But beryllium and helium also being really predominant in the United States. And this has been all the more reason for many in the United States and elsewhere to emphasize domestic production to try to decrease the risks of any tightening supply chains where expropriation might occur for some of these critical minerals. But we also want to think about NOCs as well, and think about oil as still playing a role in this conversation. And in particular, countries that have these national oil companies, there is a big question as to whether or not they are going to be champions of clean energy, or in fact, kind of pushing against and fighting against the transition. Well, on the positive side, what we've seen is that you have these extremely large companies, right? National oil companies are huge, as I've said before. They can take on a lot of risk. They can think in the long term, right? Their shareholder is often just the state, right? Or even just a majority of the state. You have seen some evidence of this, both in the more advanced economies like Norway, where Equinor, formerly called Statoil, has been very much involved in offshore wind, kind of converting some of the knowledge base that they have in developing offshore oil platforms, taking that to offshore wind platforms. This is the Dogger Bank wind farm. This is shared between the UK and Equinor. You see this also in Oman, in the Gulf states as well. This is the largest solar thermal plant in the world. This is a gigawatt of thermal. And right now, you know, the Petroleum Development Organization of Oman, the national oil company, is using solar thermal for enhanced oil recovery, but it's still a technology that they're investing in at a huge scale. So they have the assets to potentially shift away from fossil fuels if needed, but the question is, are they going to do that? Well, the record has been a lot less optimistic when you look across the board. Some research that I've done with colleagues at Oxford, Toronto, and the University of Maryland on international oil companies, you know, companies like Exxon and Shell, BP, Total, as well as Equinor. What we found is that, you know, even those companies are not doing very well on efforts to decarbonize. NOCs from other work we've seen are lagging even farther behind the IOCs, both in total research money as well as what they're devoting or prioritizing in terms of R&D. So you can look at patent priority that's being done. So, you know, Equinor, you know, they still, you know, yes, they have these great instances of offshore wind and everything, but they still largely prioritize upstream oil and gas. If anything, they're shifting more to gas than they are, you know, even thinking about renewables and the transition away from hydrocarbons. So the question then is, what role can we expect national oil companies to play? You know, what are what can we contribute to discussion from a political science perspective? Well, the challenge is going to be that NOCs, as well as extractive state-owned enterprises, which I've alluded to a little bit throughout the presentation, I talk a bit about them more in the book. Companies like Coal India, Codelco, Shenhua Energy, extractive SOEs and national companies just are the resource stewards for their countries. Their goal is to maximize the political and economic value of oil, gas, and the minerals resource base of these countries. So it's very hard to imagine them diversifying or having incentives to diversify away from that resource base. And instead, what we're seeing or what we're thinking about is this potential to double down on oil. There is a real possibility, as Patrick Heller and a number of others have shown from the NRGI, that as international oil companies are reducing their investments in upstream exploration, that national oil companies are filling the gap, that they are actually increasing their investments. And this is going to have major implications for the fight against climate change and also these countries' own national economies. While they're doing that, they are also thinking about a world in which oil may not play as large a role in particular liquids. In the medium term, you're seeing investments in plastics and petrochemicals. And these investments may or may not be well guided. It's an open question as to how much global demand there will be for plastics and petrochemicals. A lot of the projections they're working on are very optimistic when you compare them to what we might expect to see in a net zero world by 2050. And so you have some long shots as well in thinking about pivoting to blue hydrogen, thinking about generating hydrogen from natural gas. There have been a lot of plans for this. Of course, both outside the NOC context, but also in the NOC context as well. Saudi Arabia has had this discussion about being a hydrogen exporter, kind of replacing LNG in places like Qatar with liquid hydrogen. Of course, the other long-term option is to be the last man standing. It's worth noting that many of the national oil companies, in particular those in the Middle East, have the lowest cost production. They also have very low carbon intensive oil production chains. So scope 1 and scope 2 emissions, much lower than outside the Middle East region. Especially as they reduce flaring, which has been kind of a key problem. In that context, you could think about companies like Saudi Aramco and Qatar Gas as being the last ones to be supplying the very limited demand that might exist still in the next 25 years for oil and gas. They still have this comparative advantage, and that's where we might see NOCs is still playing a big role. So to wrap up, I want to kind of reiterate some of the points I'd made earlier and kind of give you a sense of some of the takeaways here. NOCs, national oil companies, and oil nationalizations are politically and economically huge, right? These are behemoths in their host countries. These play a very large role on the domestic side of both politics and the economy. They're a tool for consolidating power, especially by leaders who don't think they're going to be in power longer. This is a way for them to paradoxically become stronger, even though they were weaker, whereas the stronger leaders may not go down this route and may end up becoming weaker as a result. But I also, want to turn your attention to thinking about the implications of oil nationalizations of the past for critical minerals of today, and thinking about the context and the factors that we might want to look out for that played a big role in oil and gas nationalizations that we might apply to things like cobalt, niobium, and beyond. Thinking about who has technical preconditions, who has this high homegrown operational capacity. Where are there significant gaps between host and firm that the governments want to narrow? And where do we see highly insecure leaders presiding over highly concentrated reserves and asset bases of these extractive resources? Well, I will end it there. Thanks so much for tuning into this. I'm very much looking forward to your questions. I've got my email here and my Twitter handle, my website, and of course, here's the cover of the book. It's available on Amazon and as well as from Cambridge University Press.
Right, excellent. Thanks a lot, Paasha. Really interesting stuff. So we do have in the Q&A box one question, and I have another question for you. So let's start with with Liam Masterson is asking, were you influenced by the selectorate theory when looking at the logic of political survival?
That's a great question, and thank you, Liam, for this question. It's definitely baked in there, right? You think about all of the elements, the elites versus the mass public that leaders need to placate to stay in power, and indeed, in cases in which, in particular, where the selectorate is smaller, you think about how can leaders co-opt those elites and also effectively repress, lack of a better word, opposing elites. Having the revenues to do so is one, but not the only key element of this puzzle. And I get more into this question when it comes to the issue of the Shah, but also other leaders as well. As I mentioned, the other case studies, Ba'athist Iraq being another key one of leaders who were able to use this money in addition to other strategies that we've seen from Buena Mesquita's work. So it's definitely in there, and it's a great question of thinking about the logic of survival.
So let me ask the next question myself. So I am interested in your view on these national oil companies in transition. So to what extent do you think some of these bigger ones, let's say like Saudi Aramco, or are they really able to do this? Like, is it possible for these companies to kind of ambitiously, aggressively move away from their current primary business? What do you think about all this?
Yeah, that's the trillion-dollar question, as it were. As I kind of said in the penultimate slide, I guess it is, the incentives are just not aligned for that to happen, right? I mean, these companies like Aramco have been, designed and have been, in terms of their strategy and their advantage, to maximize the oil and gas base. It's very hard to see them moving away from that core skill set. In particular, they might invest in large-scale projects that might look as though they are indeed again, decarbonization in some sense, trying to reduce some emissions through their supply chain. But at the end of the day, they're an oil and gas company, and in terms of Saudi strategic decisions, in a way, it makes more sense not to necessarily try to convert an existing SOE to a clean energy SOE, but rather create one from scratch if you're going to go down the route of state ownership, or think about not going down that route, right? Thinking about private investment and thinking about how to do this from a private but regulation-heavy standpoint. So it's just hard for me to see this, and in particular, some of these bigger companies just also have an advantage in staying in oil. There's still going to be even the most optimistic projections still have up to 10 million barrels a day of oil consumption. Right now, it's about 100 million barrels per day. So even with a 90% reduction in oil, you're still going to have to be consuming 10 million barrels. Where's that going to come from? It's not going to come from U.S. fracking. It's not going to come from high-cost producers. It's going to come from Saudi Arabia. It's going to come from Kuwait, from Iran, from the North African countries as well. So it's hard. On the other NOCs, there's where you see more of an existential threat. When you talk about high-cost national oil companies, take a case like Nigeria, where the national oil company doesn't even get that involved in operations to begin with. There it's hard to imagine them succeeding in a world where they double down on oil. So they either have to do something to get away, or they're going to die. They're going to die out. But I guess I'm more pessimistic on seeing a 100% green Saudi Aramco than I am maybe seeing a different company in Saudi Arabia do that. But we'll see. It's a great question, and one we're thinking about a lot.
Let me follow up on that before I get back to the audience questions. So what about this idea that some of these major producers with very low production costs and high quality oil, are they threatened by this energy transition? What do you think of the strategy that the Saudis could just like sit and wait and be producing oil for a long time when the high cost producers are the ones who are really struggling? What do you think about this argument?
So I think there is some validity to it, because there is still a threat to the current business as usual model, right? Even in that oil constrained world, there will be a demand for basically net zero emission oil production. That means increased investment in carbon capture and storage, increased investment in any way to reduce both, scope 1 and scope 2 emissions throughout the value chain. That's still something that they need to do. I mean, that's not, that is not business as usual. That's not what they're comfortable in. They're investing in CCS. They're investing in the crazy things like solar thermal for enhanced oil recovery. And so there is still a threat, right? And there is a sense of an existential threat in a more, in a world in which, not all of your oil may be the lowest cost oil, and so you're thinking about, especially if you're not Saudi, but, one or two down the line, you want to think about, well, okay, yes, I have this small slice of my oil production that is going to be very competitive, but the rest of it's not. So what am I going to do? I still need to fill that revenue gap. And so there is a threat about, well, what's my economy going to rely on if not this? And Iran is in that camp a little bit, and that's where you see a push for petrochemicals. It's like, look, we're going to get the best at this. We're going to go this route, and thinking about the use of oil in a non-liquid sense, and try to gain a comparative advantage there. There's definitely an existential threat from the other side, right? Those that don't have any of this advantage, both national oil companies and effectively all of the international oil companies, the IOCs. And it's interesting to see, a few of them not going this route. There was an article last night or this morning from FT about Exxon, something that we've been doing looking at in our own research, separate from the national oil company story, that Exxon is really trying to be the last one standing. They just, they're going to double down on fossil fuel investments. They're going to continue to buy up oil and gas assets. They are trying to survive as an oil company. They don't believe there's an end of fossil fuels. And so, some don't see the writing on the wall. And, whether or not you believe it, this has been one reason among so many others as to why they've been, why their investors are not as happy as they once were, to put it lightly, in terms of their value, their stock value, and as well as their kind of brand value, dropping out of the Dow. Industrial, of course, was a big hit to them. So it's not, there are some that don't believe it, and that has been driving their decision making. But so many of the others are trying to pivot away. And the last thing I'll say is, for all those decisions that you've seen probably over the summer, announcements of net zero, they may not be fast enough, right? And so we haven't seen a quick enough move away. It's great that companies are announcing this. How quickly they're doing it is still cause for concern, right? There is still not a sense that the transition is happening now and it needs to happen now. And there's ideas of, well, 2035, 2050, we'll start to think about it. We'll still invest in oil and gas, but we'll start to get it. That still seems to me to be misguided.
Got it. Okay, this is really great. Thanks so much for sharing those.
Yeah, of course.
I have abused my prerogative as the chair too much already, so let's go back to the audience. We have Santosh Kumar Sahu, who's asking, how would you place the role of emerging oil importing economies in this context?
That's a great question. This is the other side of the coin, and in fact, so many emerging oil economies have national oil companies. They're just downstream national oil companies. And what I mean by that is they are nationally oiled, say, refining, processing, distribution of imported crude oil that's turned into either gasoline or imported gasoline that's distributed. It's still owned from the perspective of the state. From the emerging oil economies, many of them that have thought about nationalization or that have nationalized have started to veer away from that. That's where you've seen a lot of the privatizations that have occurred over time with non-operational and non-upstream national oil companies, because the benefit just wasn't there, especially as time goes on. The inefficiencies catch up, and you start to see more privatization. There's a question about from an energy importing society, nationalization for energy security reasons, to shore up reserves, to increase homegrown production, even though you're a net importer. Certainly something the United States is often, talked about, never really seriously. There have been some discussions about nationalization from a climate perspective, which are newer, and I think those are very fascinating conversation. But from the kind of, pre-climate way of thinking about this, nationalization didn't have the same large benefits, and it seemed to be an area where a lot of the political opportunities didn't really justify a lot of the economic losses. There's great books on this. Llewellyn Hughes has written a fantastic book about privatization. Some of those, particularly the Japanese case, that had a national oil company, Japan, not a major oil exporter by any means, but a very interesting other side of the coin for sure. So it's a great question.
Perfect. Thank you for responding that. Really interesting question. Myself studied some of those Indian oil companies and trying to understand their strategies and role and all that. It's quite different from Saudi Aramco. I can tell you that.
That's right. Different ballgame. Yeah.
Exactly. So next I have Sandeep Pai. It's a very interesting question. So we have seen a lot of interesting work on climate denialism funded by international oil companies. Do national oil companies also engage in climate denialism, or is this just an IOC/North American topic?
Yeah, this is a really great question. I don't have a good empirical answer for this, and so I'll veer into speculation, which is always a dangerous game. There is a sense from some anecdotal evidence that national oil company and really their host governments, more than the companies themselves, that host governments have been active in lobbying efforts. You think about the major lobbying firms like the American Petroleum Institute, the IPAA for the independent producers. And there has been, and again, it's hard to unpack, and again, follow the money here. There has been a sense that there is financing from host governments of these oil exporting countries to lobby against climate science. So there is that, right? There's one element of the answer, which is the role of these companies and really their host countries in lobbying against it in the North American and European contexts, especially when you look in the past. The other side of it is, in the countries themselves, I suppose, there is a sense that there's less straight up denial of climate change when you think about a lot of these countries that are producing oil. There is just a different sense of, well, it's not our fault. That's kind of a message that you have seen. And it's been advanced also from the North American and European side, philosophically, it's, well, don't just blame the producers, blame the consumers as well, and blame the industry that has propagated consumption, right? Not you and I as consumers, but the enablers of consumption. And so there's a sense of we are not to blame from some of these companies, especially in the Middle East, where they don't see their role as being as large. But you don't see, you just don't see the same abject climate denialism that you do here. I mean, it's quite remarkable, right? I mean, one could accept climate science and then discount it for being, well, it's not, it's not necessarily, my fault. It's probably not my problem. And so on and so forth. On the other hand, you're seeing, NOCs get involved in adaptation and mitigation, right? I mean, there's no denying that in the Middle East, they understand the impact climate change will have on their livelihoods. And so NOCs have played a role in things like reducing the consumption of oil and gas for air conditioning, for example, while also trying to increase air conditioning consumption through renewable sources. That's an interesting game because that's freeing up money for export. So it's probably not really driven by climate, but they see the need for this to even happen to begin with. Hotter days and longer summer. So there is, a role for NOCs that have been played there in accepting the future and basically mitigating and adapting. I'm sorry, not mitigating, but rather adapting. And so it's an interesting area, but I think, this is a question where I would love to see more research. We have not gone into, in our work on IOCs, we've not really gone into any of the large emerging economy NOCs at all. It's just been very difficult to track their data. The NOCs we've looked at are Equinor, and that's not a fair comparison. Petrobras, that's not a fair comparison to Aramco or the National Iranian Oil Company or Rosneft. So that's yeah, I'd love to see more work on it for sure. But there's lots of avenues there.
Great. That's a very, very, very interesting possible future research.
Yeah,
A
yeah, for
demanding one,
sure.
I would imagine, but
Yes, exactly. If you can get that information, that's
getting that data might be
yeah.
challenging. So there are no open questions from the audience right now. Please do, if you have any other questions, feel free to include in the Q&A. So let me ask one more question then here. This may be a bit outside the talk, but I do need to take this advantage. You know, I work more on the clean energy side, so I want
Yeah,
to
of course.
take full advantage of this opportunity to speak to an expert. So what is your thinking on the gas markets in climate policy? So we've recently started to see a little bit of sort of pushback against this bridge fuel idea. How do you think about all this? Do you think gas is going to be with us for a long time, or do you think it's going to start declining? Any thoughts on that?
Well, that's a great question, and one that companies themselves, and particularly the international companies and some national oil companies, have been thinking about as the answer to their problems. You know, they've been, Repsol, for example, announced that it's not going to invest in any more upstream oil, and everybody, that came with a lot of fanfare. And they're, what are they doing instead? Gas, right? So it's not necessarily that they're putting their investment into renewables. So some companies see that as an opportunity. But even they know that's not a long-term solution, and I don't even think it's a medium-term solution unless the gas value chain and supply chain changes dramatically. That is to say, if you can get to net zero gas, that's one thing. That's going to be very costly, probably less costly than oil in a lot of contexts, right? But absent net zero gas, it just does not seem like a solution, and it's not one that that is going to be, at least from what I've seen in terms of rewarding from investments and large investment groups that have thought about divestment very seriously, and shareholder activists who have pushed IOCs away from this traditional value chain. That includes gas, and so it's cleaner. It helps these companies reduce their scope 1 and 2 and 3 emissions for sure. But it's, it's doing a little bit of this as opposed to the steep curve that we need. The other side of it, which I'm far more pessimistic on, is that, so far in the extraction of gas, you have seen a lot more damage being done when it comes to natural gas flaring and venting. And straight up leakage of methane. And as we know, methane is far more potent to greenhouse gas than carbon dioxide. And so for all these years, we've known the technologies to extract natural gas for over a century. And yet you still see so much flaring and venting, even where the gas has a market for consumption. So there's a dirty side to gas that doesn't get shown as often, and can be in some instances dirtier than oil. So we had analyzed this about 5 years ago. David Victor and I and a couple other folks at the World Economic Forum thought about gas as a bridge fuel, as a question, and decidedly came down at the answer. Well, no, not unless it's decarbonized. And if you're going to get to that, cost expense, you might as well invest in renewables, which are more profitable than trying to decarbonize natural gas. It just, the numbers don't add up after a certain point, and they already don't add up when it comes to electricity. So I am a far more skeptical about this than some of these companies might be acknowledging. One last thing I'll say about that. I see a couple of other questions have come up about this, but even BP has thought about this in their latest projections. Yes, gas is playing a role, but they are seeing a vision of a future that relies less on hydrocarbons in general. So there is a sense that this is a real problem. The bridge to the bridge fuel is not the conventional wisdom, I don't think.
Okay, great. And it's fascinating how that shift came pretty quickly, right?
It did.
5
That's
years
right.
ago, we would have had a very different discussion, I think. So.
Well, I mean, the truth too is renewables just make more sense, right? Economically, it's just, you look at the cost per,
exactly.
and it's crazy. It's yeah. Anyways, I don't want to take up more time on this.
So we have 2 more questions. John Michael Murray is asking about Do any national oil companies seem to be interested in harnessing their core skills for hydrogen infrastructure? Green, not blue, or advanced geothermal? Is that a future of investment, a future investment opportunity they might be looking at?
Yeah, that's an interesting question. You know, there's not a lot of evidence. There's some instances of this where you would expect this to be something that oil companies in general, not just national oil companies, would be able to do, because there is some advantage from a processing standpoint in terms of, you know, these companies' experience with oil processing and applying the same technologies or similar technologies to producing hydrogen gas or hydrogen liquid, really, not gas. So there's two sides of it. So blue, you've seen a lot more on blue hydrogen, and then to kind of unpack that, that's kind of producing hydrogen from natural gas. So that's not as, you know, that's why we don't call it green. There are some, you know, investments. So there's a very fascinating project in the northeast corner of Saudi Arabia. I'm sorry, the northwest corner of Saudi Arabia called NEOM, which is looking at green hydrogen and thinking about developing infrastructure for the export of green hydrogen. It's a moonshot kind of exercise. That's what you see a lot from a lot of these. I've seen so many of these projects from the Gulf, but this is an interesting one. They've poured about $5 billion into it, so no small project at all. It's called NEOM, N-E-O-M, and it's more than just the processing and creation of green hydrogen, but it's also trying to create a little mini city that is, you know, fully 100% green. We'll see what that, to the extent that that works. And it is one in which, you know, engineers from Saudi Aramco, I'm sure, are playing a role, but it's not a Saudi Aramco driven project. So it's kind of like the answers I gave before. It's not necessarily that you'd see NOCs doing this, but countries in which NOCs play a big role, you're seeing kind of parallel developments of this. That's probably one of the biggest ones that I've seen in terms of green hydrogen among NOCs. But you know, it's an interesting, like I said, I think of it as a long shot or a moonshot, the same way we think about cold fusion. Probably much more viable than cold fusion because we know the technology to do it. It's just getting out of the mindset that's so difficult for some of these players. But you are seeing some of that as well. There's lots of overlap. So that's where, especially on piping and processing. So you would expect to see more of this potentially in the future. It's still not cost effective, but you know, technologies are changing all the time. So
got it. Okay, great. So let's take one more question. Sunday Pi has a question. If you could speak about unionization in national oil companies and if they have any political power on these climate issues, and in particular in the Middle East.
Another great question. Thank you, Sandeep, for this and for your earlier questions. You know, this is something I didn't talk about in the presentation, but, you know, national oil companies are far more labor intensive, if you want to use that phrase, than international oil companies. In other words, they have way more employees than they should have, given the structure of the industry. And because of that, you have these very large, effectively, you know, blocks of workers that do have a role and do have a voice in the political process and the management of these firms. You know, you can think of companies like ONGC, even outside of the Middle East, that employs more than 100,000 people. You don't need 100,000 people for a national oil company. You know, I've heard it said that you need under 1,000, which is a little bit crazy, but just in the upstream. And so, you know, in terms of their position and pro-climate, you know, they're, as you would expect, a lot of the labor movements in particular in places like Iran and in Saudi Arabia still see a future for oil. They still see a future for oil coming from them. They still see, you know, so in effect, you're seeing an anti-climate perspective there. This is not unlike, you know, one of my colleagues, you know, Matto Mildenberger's latest book, Carbon Captured, which looks at these, you know, strange bedfellows, right? You know, left-leaning, usually left-leaning unions teaming up with right-leaning industry groups to oppose climate policy. So you're seeing some of this in the NOCs that have very large workforces that therefore have very large union control. An area where this is playing out really interestingly right now is Mexico. And the union has had a large opposition to the privatization that had been happening under Peña Nieto. Of course, that led, one part, of course, of the things that led to the election of AMLO, their current president, promises to reverse that. He hasn't really done that. So there has been pushback against some of the policies that you might somewhat view as more pro-climate by the union, but it's been a mixed bag. And there is a long-term view as well to thinking about, well, if we're not going to be the oil of the future, if we're not going to be the company supplying this, how are you going to transition us to a different industry? How will a country that may not play a role in the future of oil, how will they move 70,000 workers into renewables, into something else? What's their plan for a just transition? What's their agenda? What's their strategy? They want details because they think this is coming fast. And so there it's more of a, I guess the question is not pro or against, but it's like, what do we do when this happens? And do something about it. And so it's a very interesting dynamic, and it's playing out almost as in parallel as what you would see outside the national oil companies. But it's just interesting to note that they have a bigger, unions effectively play a much larger role in a lot of these companies than they ever would in international oil companies. So it looks more like the steel industry than it does the non-nationalized oil industry in many ways. But an interesting question to think about for the future.
Excellent. Well, thanks so much for Paasha for the great presentation and taking for taking all these questions. It's a real pleasure to have you here, and I do hope we can host you in person one of these days once this pandemic thing is over. But thanks again, and thanks to the audience for attending. I really enjoyed the discussion. And again, check out Paasha's book. I put the link into the chat window, and check out SciSe-ISEP for all of our research events and activities. There's quite a bit of stuff coming. See you all next time. We will have a discussion of the Indian clean cooking fuel, so talking about those importing companies. Thanks a lot, everybody. Have a good day.
Well, thanks again. Appreciate it. Bye.